Equity mutual funds are funds that mainly invest in stocks to help your money grow. If you're looking for long-term wealth creation, they can be a great option for you. At Stackwealth, we offer customized portfolios or stacks built to match your goals and risk preferences. Plus, our wealth managers help adjust your portfolio as the market changes. Are you already investing in mutual funds or are you planning to start investing? Let us know in the comments. And if you have any questions, we'll get back to you as soon as possible. An equity mutual fund is a fund that pools money from many investors and invests it in stocks. The idea is to grow your money as the value of these stocks increase over time. These funds come with some risk because stock prices can go up and down, but they're known for giving high returns if you stay invested for the long term. In the Indian context, as per current SEBI mutual fund regulations, an equity mutual fund scheme must invest at least 65% of the scheme's assets in equities and equity related instruments. An equity fund can be actively managed or passively managed. On the other hand, index funds and ETFs are passively managed. Equity mutual funds are principally categorized according to the company size, the investment style of the holdings in the portfolio, and geography. The size of an equity fund is determined by market capitalization, while the investment style reflected in the fund's stock holdings is also used to categorize equity mutual funds. Equity funds are also categorized by whether they are domestic, that is, they're investing in stocks of only Indian companies, or international, which is investing in overseas companies. These can be a broad market, regional, or single country funds. Some specialty equity funds target business sectors such as healthcare, commodities, and real estate, and are known as sectoral funds. Let's look at the different types of equity mutual funds and how they work. Large cap equity funds invest a large portion of their money in companies with big market capitalizations. These companies are stable, dominate their industries, and are less volatile than smaller companies. Large cap funds are known for providing stability and sustainable returns, especially during tough economic times. However, they might underperform smaller companies during periods of economic recovery. Mid-cap equity funds invest in mid-sized companies that are still growing. While they carry more risk than large-cap funds, they also offer more growth potential. These funds are perfect for investors willing to take on moderate risk while potentially higher returns. Small-cap equity funds focus on smaller companies, often with market capitalization of less than Rs 100 crores. These companies can grow quickly, offering higher returns, but they're also riskier and more volatile. Small cap funds typically perform better during economic recoveries, but can struggle during recessions. Multi-cap equity funds invest in companies of all sizes, large cap, mid cap, and small cap, across different sectors. This diversification helps reduce risk while offering exposure to the entire market. They're a great option for investors who want broad market exposure without focusing on one type of company. Thematic equity funds invest in specific sectors like IT, banking, or healthcare. Their performance depends on the sector's performance, so while they might give higher returns, they also come with very high risks. Finally, we have ELSS funds. Now, ELSS funds are equity mutual funds with a tax-saving benefit. It stands for Equity-Linked Saving Schemes. They invest at least 80% of their assets in stocks and have a 3-year lock-in period. You can claim tax deduction of up to Rs 1.5 lakh under Section 80C of the Income Tax Act when you invest in ELSS. These funds are a good choice if you're looking to save on taxes and grow your wealth. Equity mutual funds have the potential to give higher returns than traditional investments like fixed deposits. If you stay invested for the long term, they can grow your wealth significantly. They also offer diversification. Instead of putting all your money in one stock, your investment is spread across different companies. This helps you lower the risk of losing money due to one bad stock. Let us now understand how to analyze an equity mutual fund. But before diving into that, let's touch on an important concept called rolling returns. Now, we have already explored the concept of calculating returns. So let's build on that with an example. So now we have these return data. Now, if someone invested on 1st Jan 2020 based on this data, their CAGR or compounded annual growth rate would be 21.86%. However, for someone who invested on 2nd Jan 2020, the CAGR would be 20.68%. This difference highlights an important limitation. Point-to-point returns depend entirely on the selected start and end dates, making them less reliable for analyzing overall performance. What you need instead is a metric that considers all possible returns over a specific time period, such as how a 5-year return performed across the last 10 years. This is where rolling returns come in. Rolling returns calculate returns over a fixed period, like 3 years or 5 years, for overlapping intervals within the overall time frame. This provides a clear picture of performance consistency. Now, the definition might sound complicated, so here's a very simple example. In an 8-year period, you can calculate multiple 3-year returns by taking different starting and ending dates. So, for example, you would calculate between the first year and third year, the second year and fifth year, the third year and sixth year. This is how you calculate the rolling returns of a 3-year return period over an 8-year performance period. So the average of all these returns gives a more accurate measure of performance over that time. Now, when analyzing a mutual fund, focus on what truly matters. The fund manager's ability to manage risk and deliver consistent returns. For this discussion, we'll use Kotak Emerging Equity Fund as an example. Now, remember, this is not a recommendation for investment in any mutual fund. Let's start by looking at this fund's fact sheet, which contains all the essential information we need. So, starting with the fund description, this fund invests primarily in mid-cap companies, and its benchmark is the Nifty 150 Total Return Index. Now, if we look at the fund inception date, it was launched in March 2007, and it has over 10 years of data for analysis. The portfolio composition is predominantly mid-cap stocks with some large-cap and small-cap exposure. Now let's look at the expense ratio. Expense ratio tells us how much it costs to invest in this fund. It takes into account the administrative fees and management fees. One thing you can do is compare the direct plan of this fund with the regular plan. So the direct plan is usually a lower cost than the regular one. Another thing to ensure is that the expense ratio is competitive within the fund's category. So usually a lower expense ratio is better, but necessarily going for the fund with the lowest expense ratio might not be the right option. This is because there could be a reason for a slightly higher expense ratio. This is because the management might be better than another fund. This is because there could be a reason for a slightly higher expense ratio, and it's probably because of the fund management being better than the other mutual funds in the same category. Next thing you need to do is analyze the risk of the mutual fund. So first we have standard deviation. Now when it comes to standard deviation, a higher value indicates more risk. For this fund, the 3-year standard deviation is 24.53%, slightly higher than the category average of 24.09%. Next you have Sharpe ratio. Now Sharpe ratio tells us if this fund delivers better risk-adjusted returns compared to its category. So higher Sharpe ratio, the better the returns. Now, the final metric is capture ratio. This fund captures more upside returns than its peers while maintaining a similar downside capture. Next, you can look at the risk-reward matrix of this fund. If you visualize the fund's risk versus reward on a chart, this fund delivers higher returns around 12.5% for slightly higher risk, 21%, compared to its category. And finally, we have the rolling returns. So if you look at the rolling returns data for 3, 5, and 10 years, this fund is most consistent over a 10-year period, making it ideal for long-term investments. So in conclusion, there are 2 key takeaways. Do not invest in equity mutual funds for short durations, like 1 or 3 years, and align your fund selection with your financial goals. For instance, a mid-cap fund is unsuitable for emergency savings. And finally, avoid relying solely on star ratings when choosing a mutual fund. Always analyze whether the fund aligns with your investment objectives. At Stackwealth, we create customized stacks that match your goals and risk preferences. Whether you want steady returns or high growth, we have something for you. Our wealth managers actively monitor your portfolio and adjust it based on the market changes, so your investments are always optimized. Start by setting clear financial goals. Know what you're investing for, like retirement or buying a house. Next, think about your risk tolerance. Are you comfortable with ups and downs, or do you prefer safer investments? To summarize, equity mutual funds are a great way to invest in stocks and grow your wealth. By analyzing the right factors and working with experts, you can make smarter investment decisions.
Stackwealth is a new age investment management company that helps you take your wealth to new heights. Our team consists of experts with 25 plus years of experience managing investments for more than 1 lakh investors. Our team of experts help you curate a personalized mutual fund portfolio based on your goals and risk tolerance. They help you decide your asset allocation. They also help you identify high performing sectors to help you generate additional returns. And finally, we help you manage and monitor your investments in real time. First, download the Stackwealth app from the Play Store or App Store and complete your sign up by entering your mobile number and email ID. Now you can explore the app, get your personalized mutual fund portfolio, or browse our various investment opportunities. To start investing, you have to complete your KYC. Once your KYC is completed, you can start investing in your personalized mutual fund portfolio or explore our expert curated investment opportunities. If you're not sure where to begin, your dedicated wealth manager will help you. Now you can start an SIP or make a one-time investment. Remember, you can always pause your SIP anytime and edit the SIP amount if you want to increase or decrease it. Finally, you can sit back, relax, because our wealth team will rebalance your portfolio based on shifting market conditions, identify and recommend new investment opportunities, give you monthly portfolio reports so you know exactly how your portfolio is performing. If you found this video helpful, don't forget to hit that like button, subscribe to our channel, and tap the bell icon to stay notified, because we are making finance and investing as simple as possible for everyone. Thank you for watching, and goodbye.